Right, well, hello, everybody. Welcome to today's session. This is Adrian speaking. I'm the head of trading here at Trend Signal. And thanks for being in today's screen share. So in these screen shares, what I do is I take a particular topic each week and we just go through it. You know, we'll talk about some of the pros, the cons of whatever it is that we're talking about. We'll look at some trading strategy. We'll go through some of the basics, some of the fundamentals. And today we're picking on the stock market. So looking at how we can trade stocks. So if you've never traded stocks before, we'll talk about the different types of trading accounts. We're talking about some of the really important things that you need to think about if you want to trade stocks and shares. We're going to be focusing mostly on US stocks today, largely because in my opinion, they're easier to trade than UK stocks. They're more trend following. They tend to be easier to identify the winning trades. And really, that's all it probably comes down to is how likely am I to make money on something? Well, I think you're more likely, with the right strategy, of course, certainly with our strategies, you're more likely to make money on US stocks because they flow a lot better. In any case, we're going to be talking about all sorts of good stuff today. So look, this is live. I am talking right now. I'd like some interaction today if possible. So can you let me know if the sound's coming through loud and clear for you? On your screen, you may just see this little panel here. It might be a little bit different. Depends on the device you're on, really. But somewhere there'll be a sort of a questions button or a question mark or a speech bubble with a question mark in it. Again, depending on the type of device that you're on. Click on that and type something in, please. So just type hi, type your name, type where you're from, anything. I don't really care. Just to get the wheels in motion, shall we say. This is how and where you can ask questions as we go through today's session. Like I say, it's live for a particular reason, as I want interaction and I want you guys to be learning something too. So thanks, AJ. Thanks, Ken Lloyd. Hello to you. Andrew, hello to you. Good for Zeta, lovely. Okay, we seem to be all working well, which is great. So, like I said, today we're going to be talking about trading stocks. So I'm going to ask you all a question straight away. Have you bought or sold, invested in or traded stocks and shares before? So Vodafone, Apple, anything like that. Have you invested or traded in stocks or shares before? Just give me a quick yes or a no, please, in that questions box. Let's just see where we're at for today, please. Hi there, Marguerite. Nice to see you online. Hello, Etienne. What do we think? Let me know. Mark has. That's good. Hello, Mark. Mark has traded stocks or shares before. That's good. What about everybody else? Michael has. Robert hasn't. Okay. So it's interesting. I find that, back in sort of 15 years ago, so I've been with Trend Signal since 2004. Back then, pretty much everyone had done shares, to some extent. I think nowadays, it's become less common. I think that background of investors turning into traders is less there than it used to be. There's certainly quite a few no's coming through in the questions box there. Okay, so look, let's hold off on that question for now. I'm going to ask you one more question. Whether you've invested or traded in shares before, have you ever done it as like a CFD or a spread bet? So done it as a derivative, like a short-term type transaction, or has it rather more been an investment and buying the shares in full? So yes or no, have you ever traded as a CFD or a spread bet? Shares, this is, as a CFD or a spread bet. Don't worry about Forex, not interested in that today. Have you ever traded those as a CFD or a spread bet? Yes or no? Okay, so Mark as an example, Mark G here, he has traded and invested in shares, but what he hasn't done is done them as a CFD or a spread bet. Okay, so thank you for that. Don't know why I'm picking on you, Mark, but your answers seem to be coming in first for some reason, so there you go. Okay, so rather more no's coming in here, a few yeses, which is fine, but rather more no's to CFDs or a spread bet, just through an ISA, says Peter. No, says Raphael. Okay, so I wonder why that is. Is it because shares seem to be more of an investment rather than trading? I think I want to try and get around that. One of the things about shares is that, there's a great deal of choice. There's a great deal of movement that comes through from it as well, and they can be great to trade. They can be even good to trade even if you've got quite a small trading account as well, because, even trading the minimums with a broker, you can trade them in quite small size. They can be a good thing for traders to do. So let's go through it, shall we? So What I want to do before we get started, just a real quick, I'm just going to read the top paragraph if that's okay. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. There we go. So look, let's think about stocks. Let's think about how we can manage that risk that we talked about just then, and let's see if we can look to do it in a right way. Okay. So what we're going to do today, how we're going to trade US stocks, principally, although a lot of this you could apply to UK stocks as well. We're going to talk about something that we can use to help with market timing called the VIX. We're going to talk about something called beta, which gives us a little measure on how fast a stock goes typically, and it can help us to outperform the stock market too, which is really, really fun. And also we're going to go through a bit of a chart review and strategy review as well. So there's going to be a lot that we're going to go through. I will go through it quite quickly. This is being recorded. This will be, it's also being streamed on YouTube and Facebook. So if you want to click and follow us there and subscribe and like and all that sort of good stuff, you can do. You'll be able to pick up the recording on those channels as well. Okay. So let's first of all get into it. Let's talk about the different types of trading accounts here. This may not be the glamorous side of things, but I think this is the sort of fundamentals that we probably should know and need to know. The first thing is shares. You know, most of you in today's session that have traded, invested in stocks before have done it within a shared trading account, okay? So the thing about that is that's typically no leverage. So leverage is when you borrow money in order to trade the position. That sounds kind of scary, right? And yet it's something we're used to in day-to-day life. Our house, for example, we use leverage when we buy our house. A lot of people use leverage when you buy a car. So if you think about your mortgage, that is, and your deposit that you put down on your house, that is really no different to what happens with a CFD or a spread bet. So it's something we're very familiar with. We put a deposit down with a CFD or a spread bet, and then we seek financing for the rest of it, which is quite cheap, just like it is with a mortgage as well. It gives us greater opportunity too. When you're trading shares, typically within your ISA or your pension fund or stocks and shares account, then typically there is no leverage available. So if you wanted to trade £1,000 worth of Vodafone shares or Apple shares, hey, guess what? You need £1,000 on your account to do so, plus perhaps a little bit more for dealing costs. Typically, with that type of account, you can only make money on rising prices, apart from dividends, of course. So you can't make money on falling prices from a typical share dealing account. So it's what's called long only. Shorting is when you can make money on falling prices, and you can do that with CFDs and spread bets. The leverage available with a CFD or a spread bet, a derivative account, is usually approximately 5 to 1. Okay, so what's interesting is on a share dealing account, if you wanted to buy £1,000 worth of Vodafone shares, you need £1,000 on your account. For a CFD or a spread bet, you need about £200. Okay, that means a couple of things. Number one, it means you could trade it with less money on your account. It means you could trade bigger size with the same money on your account, or it means you could diversify and trade more positions. So instead of just doing Vodafone with your £1,000 on your account as a CFD or a spread bet, you could trade 4 other positions with your size as well, okay? Then you could diversify your risk that way. Or you could just put £1,000 in the account and trade £5,000 worth of stock, 5 to 1, okay? The deposit being the 1, times it by 5 is your buying power, effectively. That's what you could potentially borrow or trade up to in order to do that. Borrow sounds like a scary word. The financing cost, the cost of carry overnight is very minimal. And typically, you know, a lot of traders are not in positions for very long to make it an expensive thing anyway. But the point is that leverage, that buying power is available. That's the way to think about it, buying power. Long and short with the CFDs and spread bets. The other thing, the difference between shares and so on, now this is perhaps a little bit more for UK stocks, but you have to pay stamp duty on UK stocks. That's approximately, well, it is 0.5% when you buy your stock. With CFDs and spread bets, there is no stamp duty. So there's an instant saving cost-wise of 0.5%. Now that may not sound like a lot in trading, in investing terms. If you're in a position for, you know, 6 months or 5 years, 0.5% is not such a big deal. But when you're trading, it's typically shorter duration, which means, let's say you're looking for a 2, 3, 4, 5% move. Obviously, 0.5% is quite a large proportion of a 2% move. In fact, it's a quarter of your profit is gone straight off on stamp duty, on tax. I think we'd all prefer to save that if we could, and of course you can if you're going to trade as a CFD or a spread bet. Now, capital gains tax, that's tax on profits. It's a nice problem to have, let's face it, and under UK legislation there is a certain tax-free allowance you can make each year before you have to pay any tax anyway. If you want to avoid that completely, you can trade it as a spread bet under current UK legislation, so that can be quite advantageous. Now, when it comes to share dealing or with commissions, it is kind of based on the broker you are. So different brokers can be different charges, right? So let's say that your broker you're with wants to charge you £10 a deal. Give me an idea, guys. What are you charged by your broker? Are you charged like a commission fee with a share dealing broker? Is it £10, £12.50? What would it be? Let me know. Just give me a sort of a price that you typically get. So Peter H, you trade through your ISA. What do you get charged for a commission? You can let me know in that questions box. Okay, let's say, for example, it's £10 to buy. It's going to be £10 to sell as well. So what happens is typically on share dealing, it used to be a percentage, but now it seems, well, it used to be a percentage and a contract fee. Now it's typically a fee amount per. So £9 says Andrew there. Let's call it 10. My maths says will help with that. So if you want to do £1,000 worth of Vodafone shares, or whatever, and you would charge £10 per side, what is £10 as a percentage of 1,000? That's 1%. Okay, obviously the bigger the trade size, the smaller the percentage effectively is, but effectively what happens is if you're going to trade shares and you do £1,000 worth and you'll charge £10 a deal, that's 1% in plus another £10 out, that's another 1%, plus your stamp duty, that's a 2.5% commission and fee that you would have for that opportunity within a share dealing account. Now that is quite a lot, of course, and that means that stock has to move 2.5% in your favor before you are break even on the trade. Okay, does that all make sense, everybody? Give me a quick yes or no in the questions box. So if you add those costs up, so £10 as a percentage of £1,000 is 1%. If you trade £10,000, it's obviously a lot lower. It's going to be 0.7% will be the cost. But let me know, guys, is this making sense so far? Yes or no? That'd be great to know. Now let's compare that with a CFD or a spread bet. Now the thing about a spread betting account is there is no commission fee per se. What a broker will typically do is widen the spread out a little bit, and that's usually widened out by 0.1%. Okay, it can be varied, and that's a rough sort of ballpark for you. Now bear in mind there's no stamp duty on a CFD or a spread bet. What that basically means, again, if you're going to do £1,000 worth, okay, you'd only need £200 on your account for that, by the way, so let's bear that in mind. But let's say you did £1,000 worth of the equivalent trade size on a spread betting account. What would your actual cost be? Well, it'd be the equivalent of 0.1% in, 0.1% out. That would be a 0.2% fee. Okay, all right, it's worth to know. Okay, so Peter H about £11. So £10 ballpark gets us in the right sort of ballpark, doesn't it, Peter? So effectively, a spread bet will cost us about 0.2% for the equivalent trade. It saves us on stamp duty and it saves us quite a lot on commissions. I put a caveat in there that actually, the bigger the trade size you do, it might end up being cheaper to trade shares, but it depends on, you need to be trading quite lumpy size, to be honest with you, particularly given this. In fact, it would never be cheaper because you've got stamp duty. So share trading is always going to be more expensive if you're trading UK stocks because of that stamp duty fee. You don't have to pay it on US stocks though. But either way, 0.2%, broadly speaking, on that equivalent transaction. Now, trading as a CFD, it varies on the broker you're trading with. Sometimes what they do is they charge you 0.1% with a minimum of £10 a deal. Okay, so in the same case, your charge there, your charge would be 20 quid, which would be 2%. Okay, so again, the bigger size you trade on a CFD, the cheaper it becomes. The cost is the same in percentage terms on the spread bet. What you effectively see is that if you're trading quite smaller size or normal size, should we say, usually a spread bet is the best option, or you want to trade with a CFD broker that does not have a minimum commission charge, because it just hits you quite a little bit. So it'll be a little bit sensitive to that if you can, or if there is a minimum charge, you want it to be as low as possible to give you a bit more flexibility. Okay, we all okay with this? That gives you a broad overview of the advantages there. When it comes to leverage, just because you have £1,000 in your account, just because you can trade £5,000 worth, doesn't mean that you should. You know, what you're doing is engaging in a lot of risk there potentially. But like I said, what you can do with a CFD spread bet account is you can put less in your account and still have the same equivalent buying power, or you could just trade more positions. It therefore diversifies your risk and potentially still gives you a lot more opportunity too. All right, so good. We should be all pretty okay with all of that. Now, there is one other thing when it comes to overnight fees. You know, we talked about buying power, we talked about the cost of a mortgage, if you like, but which is the equivalent when we talk about leverage with a spread bet or CFD. What is that cost? Well, you have an overnight funding rate. The longer you're in a position, the more it'll cost you. Usually what a broker charges you is an interest rate. Let's call that, I don't know, let's call it 1%, whatever it happens to be, plus their markup. Let's call that 3%. Okay, that gives you a 4% fee per annum. All right, so let's say we did £1,000 worth of the stock. Let's keep it nice and in pounds, nice and easy. Times that by 4%. And what is that? Well, that's 40 quid. That's the cost for carrying that trade for the entire year. Now, what would that be per day? Well, we take our £40, you divide it by 365 days in a year. That is the equivalent of 11 pence per day. Okay, so that's what it would cost you per day to hold a £1,000 trade. Broadly speaking, you know, brokers are going to charge different fees, whatever. But broadly speaking, 11 pence a day to hold that position. And it would be cheaper to short it, by the way, because the way it works, it's 1% plus or minus 3%. So anyway, let's call it 11p. Let's say you're going to hold that trade for a week, 11 times by 7. So that's going to charge you 77 pence for taking that trade, which is 0.7%, still significantly cheaper than the dealing costs otherwise. Okay, but obviously, you know, there comes a point where, you know, the costs, you know, overtake the stamp duty and other costs there. But the point really is that actually it's pretty cheap, really. Okay, so, you know, there are significant advantages, and typically the trades we're going to be talking about today, we're in them for like, you know, a week maximum really anyway. All right. So with that in mind, typically spread bets tend to be the best value. CFDs can be very good value as well, but be aware of a minimum commission. That's the biggie, particularly if you're a beginner or trading smaller size. Anything less than about £5,000 to £10,000 deals, you really want to be very careful on the minimum commission charge. Okay. All right. Are we good with all of that? Give me a quick yes or no. Is that all okay? Making sense? Yeah, and if you need help with the spread bet or CFD account, that's something we can help you with. Just email into our email box. All right. Okay. If we're going to trade stocks, there's a couple of things we need to be aware of. You know, when we're trading Forex, we're trading indices, we're trading commodities, we'll typically be aware of, you know, market-related events, you know, economic data, that sort of thing. The equivalent is earnings data for stocks. Okay, so UK stocks typically will announce their results that are final and interim results, so every 6 months. In the US, it's typically every 4 months that a company will report on its earnings. So that's what they call it, their earnings season. You should check this. Okay, the reason you should check it is because it can create a bit of a jump in a price. And bear in mind that as traders, what we do is we look at what the market is telling us at the time, and the market should, in theory, carry on in the same way it was going unless new information comes to light. Now, what might that new information be? Well, how about how well it's performed over the last 3 months, how much profit it's made or losses it's made? And remember, stock market movement, any movement on any market actually, will be based on what the announcement is versus the expectations. So when a company comes out with its earnings and says, oh, we've made X amount over the last 3 months, if that's a lot better than expectations, yeah, the stock will typically go up. If it's done worse than expectations, the stock will go down. The point is, it is new information. And if you go on the basis the market will typically carry on the way that it was unless something changes, then this is big change. And this big change can create big change in price as well. So when you have a company that's coming up to its earnings results, be mindful of it, please. You might want to think about not being in the position. So for example, if you were long, it'd be a pretty good idea to close that trade off beforehand. And the reason for that, the gapping there creates slippage, and that's something we talk about in other Tuesday events. We're not going to talk about now, but it creates a risk opportunity. So if you're going to trade, you need to be rather more sensitive to the earnings that are taking place. The good news is that that's something you can be aware of. So you can get an earnings calendar with the NASDAQ.com, with YahooFinance.com. There are a number of them out there. Just do a quick search for the stock you want to trade. This is Walmart. When are its earnings dates? When is its reporting its date? Well, there was one there on the 18th of February. Okay, so if you're in the trade on the 17th of February, you might want to think about closing it. This is the equivalent. If you're already trading Forex or whatever, this is the equivalent of, say, non-farm payroll. It's the equivalent of US interest rates if you're already trading the US dollar. You might want to think about closing it into that number. Okay, how do I get dividends when trading with you? Okay, well, first of all, I'm not a broker, but dividends are reflected in CFDs and spread bets as well. You normally get it after tax. You don't have to faff around with the tax voucher and stuff. But you know what happens is, it's a really interesting point. You have an X date with dividends, Marguerite, and you have a pay date. Okay, so with dividends is when a company pays out a proportion of its profits out to its shareholders. It's a bit like saying, yeah, thanks for investing us type of thing. It's your income, if you like, as a shareholder. What there is a certain day where they take the register. This is the X date. So whatever date that happens to be, if you own those shares, whether as actual shares outright or whether as a CFD or a spread bet on the X date, you will be entitled to that dividend. If you are short, you will need to pay that dividend. Okay, you can't have it both ways, because what typically will happen is if you have a 5p dividend, all other things being equal, that stock will fall by 5p or 5 cents, whatever it happens to be. The point is that you don't get any free money in this game, sadly. But the X date is the date on which they set the register. Now, here's the difference between a CFD and a spread bet. As trading or shares, sorry, if you're trading shares, you will get that money probably in a month's time or so on the pay date. Okay, that's when you'll get it. If you trade as a CFD or a spread bet, you get the adjustment on the day. Okay, so typically you'll get it on the X date or maybe the day after, but you'll get that cash adjustment on your account according to the dividend or the income for that particular trade or instrument you have. So if you're long BP, you'll get it on the X date rather than having to wait for the pay date later on. Does that make sense, Marguerite? But you still get those dividends, and you know they're tax adjusted at source, so it's all pretty straightforward anyway. Yeah, we happy with that? Good question, by the way. So don't think that just because you're on a CFD or spread bet, you don't get dividends. You know, you still have the impact of them, which is good. Okay. So here's an example of an earnings calendar. You know, this is with whatever, NASDAQ.com. You can go to NASDAQ.com. You can find it out for yourself. It's not particularly complicated. And you can search for the stock and, you know, all that sort of good stuff. Pretty straightforward. What you'll often find with these earnings calendars is you get like a, you know, after market close and before market open. Okay, so certain earnings are before the stock market opens, certain ones are after the market closes. Okay, it's just something to be aware of. Small things, but you know they do make a difference. Okay, good. Hopefully we're all okay so far. This isn't necessarily groundbreaking information, but it is good basic information that you should be aware of. You need to understand the fundamentals of how an account works, and you need to understand the fundamentals of, you know, things like earnings, because they will have an impact on the performance of your trades. You know, that's irrespective of whether you are a Trend Signal member and you're using our strategies and so on and gone through our education program, or whether you're just out there doing it yourself. You need to be aware of the earnings calendar. Okay. Now, look, there's a couple of things. I'm going to talk about strategy in a second, but there are a couple of other bits that I think are really worth you guys having a look at. Now, I'm going to go through this relatively quickly because if I don't, I'll be talking about it forever. But also, you know, I do want to get on to trading strategy in a second as well. Now, this could be a little bit more complicated. Take it or leave it. It's entirely up to you. But one of the things you can do to look at stock market timing is to look at a market called the VIX. Now, who here, yes or no, has heard of the VIX before? And if you have, do you have any idea what it's all about, what it means? You can give us a quick yes or no. Do you know what it means? Have you heard of it and you know what it means? Yes. Or haven't heard of it, no idea, no. Just let me know. Mark does. Good. You've probably been at one of my sessions before, maybe, Mark. Your name's definitely familiar, that's for sure. Ken Lloyd has. Eddie hasn't. Let me know, yes or no. Okay, lots of no's coming through now. Okay, so what is the VIX? And VIX gives us a bit of a measure of, they call it like the fear and greed gauge, or the fear gauge, basically. What's fascinating about the VIX market? It's something that's quite difficult to trade in its own right, and I won't get into the reasons why here, but what you basically have is a gauge which is kind of like a mirror image for the indices. So what I've got on this chart is the VIX in dark blue, and in lighter blue we've got the Dow Jones, so the Dow, Wall Street, whatever. You've got that over time. What you can see is that typically whenever there is a trough in the Dow, there is typically a peak in the VIX. You can see that here and here, see it here and here. You can see that there. You can see it there, and so on. They converge on each other, don't they? Yeah. The reason that this is useful is because the VIX typically is something that trades on very rigid and robust support and resistance levels. There are certain levels on the VIX, around 20, around 30, typically. When the VIX hits 30, that's typically showing us that the stock market is in major fear mode, and it's panicking, and oh my God, the stocks are awful, and it's likely to just keep going down and down and down. Okay, I would encourage you to do a little bit of homework on this, because to my mind, this is a timing indicator that's better than probably anything else I've ever seen in my life. Okay, because what you do is you look at the idea of fear and greed. So the more fearful any market is, the more everyone's panicking about it. The contrarian view is usually best, right? So if the market is panicking, that's usually the best time to buy. And if the market is complacent and greedy, and all you can think about is rising and rising and rising stocks, that's usually the best time to sell and short. So if you're doing the opposite of what the masses are doing, you're generally in a far better position. This is the same thing. So when fear is high, it's typically when stock markets are falling, but on the basis that there is a pretty rigid resistance level at around that sort of 30 level and around 20, the higher basically the VIX is, the more in panic mode the stock market is. The more in panic mode the stock market is, the more attractive it is typically to buy. So if you're looking at the stock market thinking, wow, it's getting absolutely battered at the moment, if you take nothing else out of this session, have a look at what the VIX is doing. If the VIX is north of, say, 25, it's probably quite an attractive time for a portfolio. Okay, it may not be quite right, but typically if it goes above 30, it is usually been the stock market low within 48 hours. Occasionally it overshoots, but it's usually the stock market low within 48 hours. Go back and do your homework. Don't just take my word for it. Go back and have a look at it. Okay, typically whenever it goes above that 30 level, that's where it's interesting. And actually, from there, it's not just about wading right into stocks, it's about looking at which stocks we really want to be buying. Okay, how do you look at that? Well, the best thing to do, is to have a look at here. So you can look at the chart, you can play around it yourself. This is just Yahoo Finance. Okay, just search for HAT VIX. Now, there's been quite a lot of increase in volatility this year, so it's a little bit out of kilter what it might normally be, but have a look at it. I'm not going to spend too long on it because I do need to move on, but really this is to prompt you, to give you an idea about what traders do. Of course, we teach you this all on our trading programs anyway, so if you want to learn more about it and how to then stock pick because of it. So we've seen quite a big pullback in fear. The market's becoming more complacent from a relatively high base, but these levels here, these will be synonymous with stock market lows. So these peaks in the VIX are fear, and the troughs are greed. So you just give them an idea that way. So if you line that up against your stock picking, so in other words, if you rather become more excited about buying stocks when this market hits 30, you'll tend to do pretty nicely. And that doesn't mean you have to trade all the time, all year. You don't necessarily have to. The best times, usually after we've hit 30, we'll see a big boost in performance on our strategies. And that's because when the markets tend to just roof it, and then our strategies tend to really come into their own. Okay, but it's a really good gauge. That would be the HAT VIX. No, it's not that way, is it? It's the, what is that? What is it? What is the symbol? Yes, it's that one. Okay, so that's Shift 6 on your keyboard, VIX. Search for that up here. Okay, you go look at that. All right. Quick question. Who's going to have a look at it? Be honest with me. Who's going to have a look into this after today's session? You have to do it today, by the way. Who actually will going to often have a look at it? I can tell you right now, as I said, in my opinion, I think this is probably the best market timing indicator that there is out there. Does it call it perfectly every time? Of course it bloody doesn't. Nothing does. But it's probably the best that I've ever seen. All right. So do have a look. Okay. Line it up. You can add another chart on like I did on that slide earlier. So you can have it so you can see both. Well, I actually want you to look at that. You know, look at other peaks and troughs are. Now look, a mirrored image of one thing against another isn't particularly useful because, but you know, the thing with the Dow is its support and resistance can be anywhere. You know, there's nothing to say it needs to make support or resistance at 30,000, 40,000, 10,000, anything. It doesn't really matter. However, the VIX is bound by certain controls, certain parameters in which it doesn't very often go above certain levels. You know, in 2008 it did because there was a massive crash. It was a bloody nightmare. That was a very unusual market event. And often you'll be looking at thinking, oh my God, the VIX is like 32. Oh my God, look what's happening in the market. That's quite panicky. It's like, oh God, can I really be buying stock down here? This happens all the time. And typically it's a good time to be getting into it. Does the VIX apply as well to stock to Forex? No, not really. I haven't really seen any relationship. There is something called the CVIX, John, which supposedly is to do with like volatility on Forex. I've not really looked at it because I haven't really been able to apply the data in the way in which I would like. So, but I don't think so. It's very much more for the indices and very much for the underlying stocks themselves, John. Okay, good. Let's move on a little bit. Now, one of the things you might want to consider doing is if you're going to be buying stock, we'll talk about entry points and strategies in a second, but you might want to think about which stocks to buy. Okay, so do you have an evergreen strategy? Do you think about stocks that you trade in a slightly different way depending on what's going on in the market? One of the things you can do is get an idea about speed. There is a little gauge called beta. Now you can get it on certain platforms. So for example, if I look at the markets.com platform, what I can do is I can look at the particular beta of a stock. Now this is just a demo account that I'm looking at here. It doesn't really matter what it is, but this is for markets.com. What I can do is I can look at an individual stock. I could look at, let's say I wanted to look at Vodafone, right click on the instrument itself. Hang on, what's it doing? Oh, hang on, bear with me. So I'm just going to go to the demo. Sorry, a little wobble there. So look at shares. Okay, so if I want to look at Vodafone, what I can do is go in Vodafone, right click on it, click on instrument info. And what that will do is present me some info about that particular stock. So in the key statistics, let's just move over. I can see the beta value. So this has got a beta of 0.98. So what is beta? The beta is basically a coefficient. What the hell does that mean? It's a multiple basically, and it gives you an idea about how fast a particular stock moves. If you think that the index itself, so Vodafone is within the FTSE 100, the index itself moves at a speed of 1, okay? What you look at is the speed in which individual shares move relative to the index. Some stocks move faster than the index, some stocks move slower than the index. That's all to do with its elasticity, I suppose. You know, so for example, if the market is booming, do we buy more cleaning products? No, we don't buy more cleaning products. Do we buy more technology? Do we go on more holidays? Yes, we probably do. So these types of stocks tend to move faster than the slow ones. So you have these higher beta stocks, which tend to be banks, which tend to be mining stocks. House builders can be quite quick. And then you have the low beta stocks, which tend to be household products. They tend to be utilities like water or whatever. You know, the sort of companies that we don't necessarily buy a lot more of just because we're feeling wealthier. So what the beta does, it gives you an idea about how much the market is likely to move or outperform. So if you think the indices are going to go up, then what you really want to do is to look to really outperform is you can trade the stocks that have a higher beta because they're going to move faster. So for example, a stock which has a beta of 0.5, something like Reckitt Benckiser, which is, household products that, we just buy normally. That's quite a defensive stock. You're not going to make money that fast. Okay, so if the market moves up 1% with a beta of 0.5, it's probably only going to move up 0.5%, in which case you're lagging behind the index itself. You might find a stock which has got a beta of near 2, in which case, if the stock market moves up 1%, that stock, all other things being equal, will move up 2%. And what that does is it gives you a bit of an edge with speed. So what you can do is you can look at a particular stock and have an idea about how far a particular market tends to move relative to the index itself. Okay, so you might think that's quite technical. You don't have to do any of these things. You could just trade stocks without really necessarily thinking about it. But one thing that you can do is, if you think the market's going to go on a bit of a roof, but it's going to go up because, I don't know, the VIX is through the roof, and you're thinking, oh my God, this gauge, fear gauge, everyone's fearful, therefore I should be thinking about buying stock, therefore I should think about trading the faster stocks. Maybe you can look to do that. Banks, mining stocks, those sorts of things tend to have a higher beta. So Vodafone moves at about the same speed as the index itself. That's because it's kind of in the middle, all right? It's kind of a mare type of beta. But there are other stocks which do have faster ones, okay? So Netflix, let's have a look at Netflix. So right click, go to instrument info. 1.3. So all other things being equal, Netflix will move at 1.3 times the speed of the index itself. Okay, does that make sense? Have a quick look at it. I'm not going to spend long on it because, it's just a little gauge there that might help you to trade some faster markets. So if you really think this market's about to outperform, if you have the risk appetite for it, have a look at the higher beta stocks and look to trade those. Let's say, for example, okay, I've got loads of stocks here I might be interested in buying. I can only really get 3 trades on. If you've got a higher risk appetite, you might pick 3 of them with higher betas than other ones, because you'll probably have the opportunity to make more money in them. Okay, just a little something to think about. Everybody, quick yes or no. Does that make sense too? Let us know. I know I'm going quite quickly. I'm very guilty of that. So you can take a snapshot of this if you want to. Effectively, what we have here with any company, look, Tesla, for example, has got a beta of 2, which means it moves at typically double the speed. Severn Trent, which is a water company in the UK, has a beta of 0.4. It's the most boring thing going. Doesn't mean it's not good for an investment. And it might mean it's also got quite a tight stop on it, maybe. I don't really know, and that might be kind of advantageous. But could you, if you put 10 grand into each one, which one would you have the greater potential to make money on? Tesla. Which one have you got greater potential to lose money on? Tesla. Kind of it both ways, unfortunately. But certainly, it's moving significantly faster. Okay. So greater than 1, faster than the index, slower than the index of less than 1, can be used to outperform the market itself. So it can help you with this very simple guide for stock selection over and above your trading strategy, or help you select within your strategy. Sectors like banking stocks, technology stocks, mining stocks, these are typically quite higher beta stocks, okay? Lower beta ones, utilities, household goods, pharmaceuticals. We're not necessarily buying more paracetamol just because we're in a recession or whatever, or market's getting a little bit harder. Tobacco, they could be lower beta as well, okay? Because people, if we go into a recession, people still tend to smoke the same amount. It doesn't tend to have much of an impact. It's more inelastic in that regard. It tends to be lower beta. All right. This means you can trade the share instead of the tracker. You can trade the share. Yeah, you can trade the share, absolutely. Some people prefer the trackers, some people prefer individual shares, whatever. This is just helping you to get to that point. All right, let's think about trading strategy. So momentum stocks is one of the courses that we run here. It's typically a bolt-on to Trend Signal Plus. So for a lot of people who are already a Trend Signal Plus member, they can look and choose to add a stock strategy onto their memberships, shall we say. So what is it doing? It's using a lot of similar sort of stuff that we use, although the strategies are specific to trading individual shares. So the way in which shares move is quite different to the way in which Forex moves. So therefore the strategies need to be different too. So what we have is a particular set of sniper strategies that are specific to trading stocks, US stocks in particular, although you can apply this to UK stocks too. One caveat with that is that I don't think that UK stocks tend to move in the same sort of flow. They're less liquid and so on. You don't have to be quite a strong trend following. And as a consequence, I actually find US stocks easier to trade. And really, this is a results business, right? So I'm going to be interested in trading whatever is easier to trade, whatever I'm more likely to make money on. That's not to say that I don't trade some UK stocks from time to time. It's actually what I started in UK stocks back in 2002. But it is rather more on the US stocks that I focus my attention now. Bigger moves, deeper moves, bigger potential for profit. So I tend to look at the bigger stocks, the Dow 30, the US, the S&P 100 tends to be where a lot of my opportunities go. If you think of it in this way, technical analysis is all about analyzing the data. More data you're analyzing, the more accurate your findings are likely to be. So therefore, the bigger the stock, the more actively it's traded, the better technical analysis is also likely to be. That's why traders will typically favor faster markets, more liquid markets where there is more trading activity within them. Okay, so let's have a quick look at some trades. I'll talk about the strategy. The other stuff we've talked about today, these are kind of like your add-ons. Having the right trading account is essential, okay, and we can help you with that. Understanding when a stock is going to have its corporate earnings, essential, we can help you with that. Understanding about beta, understanding about the VIX. You don't have to. These are nice add-ons that you can perhaps incorporate into your trading, maybe in phase 2 of your stock trading strategy. But what I want to do is talk about phase 1. So if you're interested in trading stocks, you're interested in the trend signal methodologies, let me go through exactly what it is that we do to help you to identify trades using the momentum stock strategy. Okay, so let me just bring my charts in and let's have a look at it. So what I've got here is a chart for, well, it's Coca-Cola, doesn't really matter what it is. I've got some scan results for trades over the last few days that we'll have a look at some of those in a second. And I've got my list of the Dow 30 stocks down the left-hand side. Here is the trend signal, the momentum stocks strategy applied to, well, this particular stock, which is Coke. Okay, so the indicators and the sniper discs are geared specifically toward trading stocks. Okay, you can go long on them with sniper trades, and then we can teach you how to identify short trading opportunities as well. Okay, and we do within our coaching and workshops and all that sort of good stuff. So what are we looking for? Let me just remind everybody, if you don't know already, what Trend Signal is and what Trend Signal does. Trend Signal is, yes, we're a trading house, but we are really a data manager. What we have done, or data analyzer, we have analyzed the movement of thousands of markets and thousands of trades, rather, I should say, to look at what types of trade setups produce the best opportunities. Okay. So what we typically look for is a repeatable entry point, something that can give any individual, whether new, whether experienced, a clear identification of a high probability setup. Okay. What this is about the turning point here. Whenever this line, it's the vector average line, which tracks the direction of price. When prices are falling, the line will be red. When prices are rising, the line will be green. Okay. What we look for, like I said, is a repeatable entry point. I look for a color change in this line to identify a market that is changing direction. If the market is changing direction, it gives us a potential and very clear opportunity to trade. So if the market is turning down, it'll be a change from green to red. If it's going up, it'll be a change from red to green. Okay. What I'm looking for is the turn to give us a potential trading opportunity. Now that turning point is very easy to identify. Now historically, what a lot of investors would do is they'd buy low, sell high. The problem with buy low, sell high with trading is, well, the advantage for an investor is that they can be in an investment for a month, for 6 months, for 25 years if they want to. They have time on their side to hope that the trade will come good. Traders don't have time on their side. Their timing, a trader's timing has to be better. Okay, the cost of carry, the use of capital and leverage means that you can't allow a trade to go from $100 a share down to $20 a share and then come all the way back up and say, oh, I knew I'd get it right at some point. A trader can't do that. It doesn't have that luxury because we're looking for more frequent opportunities over shorter durations, and we're looking to maximize where we put our capital. Okay, so what we're looking for is a market that is not cheap. We're looking at a market that is rising on the expectation it should then go higher. Okay, we look to buy high and sell higher. So we're not looking to buy low, sell high. We buy high and we sell higher. It's a slightly different mentality, and the reason for that is because you have to be looking at buying markets that are already rising. You want to cling on to their coattails, you want to jump into their slipstream and allow that momentum to take you further for a few days, a week, 10 days, something like that. We're not looking to buy cheap because cheap is a relative term, and a cheap market can just keep getting cheaper and cheaper and cheaper. Okay, so really people who want to move into trading because there's a lot more potential for profit, if you go into it with an investing type of mentality, they typically lose because all you're going to look for is a cheaper price. Okay, what you want to be doing is looking for a market that is starting to resume an upward direction and jumping in at it there. Okay, so that turning point is the first step. So when that line changes color, it's about saying, oh, look, this market's starting to turn up again. Is that a turn up in the market that I'd be quite interested in? Well, let's have a look at it. What we should be looking for are things like candlestick patterns, chart patterns, and so on, to help us to establish whether this market's got a good chance of going up. Okay, so some markets have, some turning points, I should say, have got a better likelihood of being a bigger move than others. And what do we know? Well, like I said, TrendSignal is a data specialist. What we do is we analyze a number of things. For example, this blue line here would suggest that the daily direction is moving up. The WT would suggest that the weekly trend is moving up. The MT would suggest that the monthly trend is moving up. The CP suggests that the market is showing an ascending chart pattern. So the chart pattern is suggesting rising prices, higher highs, higher lows, that sort of thing. You're seeing that the momentum of the market is green. It is pointing higher. The way in which it turned, i.e. did the vector average, did this line turn before this one, and or vice versa? What does that have to do with it? It's all built into the analysis. What we look at is for a number of these factors. We looked at the context for any turning point. So we have a repeatable entry point, i.e. the change in color, very easy to spot. Now, has that turning point, has the situation that's taking place there with longer term trends, chart patterns, momentum, and so on, has the pattern around that turn, has it got a history of producing winning trades? That's basically what this trend signal does. So we look at the turning point first, and then we look at the context around that turning point. It's a little bit like if you're going to bet on a football team. Okay, so I've got a football match coming up. Is that football team in form? Yes. Has it got its top players playing? Yes. Has it just signed anyone new that's scoring lots of goals? Yes, it does. Are they fit? Yes. Have they just been sent off for a red card recently? No. Okay, so they're more likely to be playing their top players. Who are they playing against? They're playing against a team at the bottom of the league who are losing matches. Okay, all right. So if you add all those things together, then you've basically got the hallmarks of a team that's likely to win that match. They may not do, you know, that happens, but you've got a high probability opportunity. Okay, that's exactly what we do when we look at sports betting. The reason people don't do it when they look at the markets is they don't know how to look at the form guide. They don't know how to look at whether the informed players are playing. They don't know how to look at the injury list because, Christ, who on earth, what are you supposed to look at? That's what Trend Signal does. So it looks at the weekly trend, the monthly trend. These are the form guides. It looks at the chart patterns. Effectively, that's your top players. I don't know, whichever way you want to look at it, it's an analogy, right? The point is, what Trend Signal does is it looks at the turning points, looks at what's happening at the time to build a picture. If that picture has historically produced great opportunities, then why wouldn't it again, right? You know, it's about that pattern repeating itself. That's all technical analysis is. Technical analysis is the idea of identifying patterns and the expectation of those patterns repeating themselves. That's it. This is what this does in a simple to consume way. So when the right patterns are in place, one of these discs will pop up on the chart. In this case, it's a blue one, which suggests a strong uptrend, trend following type sniper. So the pattern is associated with a strong, clear opportunity that has a history of producing winning trades. Okay, and what's the market done? Well, it's gone up about 1.5% over the following day. Okay, so this was a buy. What was that on the 12th? So what was that last Friday? And this was yesterday. Market's not open yet. You know, what will be 1:30 on a Tuesday lunchtime. So, you know, what you've had is a decent move there, in line with kind of what we'd expected it to do. Okay. Quick yes or no, everybody. Does that all make sense? Yes or no? Now, I know you may not know what's behind the weekly trend or what's behind the monthly trend and so on. I can teach you that. I don't have time to go through it right now, but it's what we do teach on the course, of course. Does that all make sense? What is the difference between a failing trend and a trend direction change? Oh, that's really the type of sniper. So it's to do with the context. So if you've got a trend direction change, you might have a buying opportunity in really what is a downtrend, John. But the market, it's starting to show signs of a change. So for example, John B, you know, if you've got a market that's doing this, you know, it probably, unless it's like Marconi, it's probably not going to stay in that downtrend forever. But do you want to be buying each and every one of these dips, hoping that it's going to go up? No, you really don't. You know, you're going to get hammered doing that because you're just trying to guess the low. So a reversal one, like a trend direction change, is more like, well, you're in a downtrend. The weekly and monthlies are down. Everything's pointing to lower prices. The market starts to go up, and then all of a sudden it does this. It's like, oh, starts to move back up again. But look, that's a low and that's a higher low. So you've got the market starting to move into an uptrending situation off the chart pattern, even though the longer term trends are down. It's like, well, it's got to turn around at some point, and it's starting to show signs, because we're starting to build an uptrend coming through, or build higher highs, higher lows, that actually this could be the market starting to reverse. These are typically pink snipers, or to that end, pink snipers. They have a pink inside. It's really demonstrating that the market may well be in a bit of a downtrend. However, it is showing signs of that direction changing. That's basically it, John B. Okay. Okay, so what we're going to do is take a look at buy. Let's think about stop losses and targets. Now you've got a couple of choices over these things, you know. So what we have with our trades is you've got an entry point there, and what you can also look at is stop loss and targets. So we've got a couple of different stops that we choose. We'll go with the semi-aggressive, which is, see where that line changes color there? Look for the low. That's your what we call a semi-aggressive stop loss. You just go with that as a nice simple go-to stop. That's what is that, about 1% in this entry. It's quite a tight stop really on Coca-Cola. And then this market's already gone up 1.5%. So it's already gone up 1.5 to 1. It's a decent move. Typically on a stock, I think a decent move is anything between 3 to 5% plus. Okay, so 5% is pretty good, and the reward to risk on a 5% objective is usually very, very strong. It's like, you know, 1.7 to 1, I think it is, something like that. Okay, I'll give you some data in a second on all of that, but that gives you a clear indication. Say typically on trades, in fact, why don't I give you some of that data now? If I have a look at that, this is the performance data since January 2017 for the Dow 30 stocks. Okay, that's about 1,000. It's more than that now, trades actually. So if you just went for this on 1.5% targets, every trade 1.5% target, 66% win rate from every trade on using this system, and that's a 371% cumulative gain. You leave a lot of profit on the table. You know, the reward to risk is slightly smaller targets than they are stops. Okay, so you're winning smaller than you're gaining, but it's okay. but you're leaving a lot of profit on the table. If you went for every trade over that period for a 3% target, it'd be a 725% gain. You're doubling it, in terms of its gain. And that's because you got a much better reward to risk on those trades as well over that period. So if you did every single trade, go for a 3% target on it, and so on, there's a significant opportunity there. This is the green line there. If you go for a 5% target, typically 2 to 1, so on average, the average winners, let's say 5%, the average losers, let's say 2.5%, so typically they're double there, 978%. Or you trade what's called the active stop strategy, which is, you buy it when the line goes green and you exit it when the line goes red. I'll show you some of those in a second. That's even better. There's a lot of potential for profit over that period there. Okay. So let's just move on a little bit. Let's have a look at some of this in a bit more detail. So you can see this is the active stop, the orange color. So this is, let's say, over 5 years or whatever. Let's have a look at a few more trades and we talk about the different types of strategies. So if you want to put a target in, that's fine. You can do that. Alternatively, if you're going for an active stop, basically what that is, let's say you bought here. Okay, the active stop will be when that line changed color, exit flips you out of it. So had that been a buy, it wasn't because there's no sniper, but had that have been a buy, it would have gone up a little bit. Let's say it didn't hit the target. Oh, look, the vector has changed. The market's telling us that it's starting to go back down again. There would be the exit. Okay, it's what we call an active stop. So it hasn't yet hit target. It hasn't yet hit stop loss, but we're looking to get out anyway before it gets worse. Okay, this is the daily chart for Zeta, which is, in my opinion, really good time frame for majority of traders, really, particularly at the starting point. You can always progress down the time frame once you're more experienced, but I tend to find it's better for traders start on something like a daily chart, 4-hour chart, and then you can always look to migrate down from there. So what we have is a series of other opportunities. McDonald's is an interesting example. You can see here that we had a buying opportunity a couple of days ago. There was a stop loss down there. So there's the opportunity. What is that? That's about a 2% stop, something like that, maybe 2.2%. And we're small in profit on that opportunity at the moment. So it's going right in the right direction. The last buying opportunity was there. Okay, what did the market do? Well, that went up to a high. See the line changing color there? That's your active stop there. Okay, so the system will be suggesting that members should get out of that opportunity at that point. How far did that market move? Well, it went from a long at 243 and it went up to 255, which is about a 4% gain, something like that. Didn't quite go to a 5% target, whatever. Again, if you want to keep it nice and simple, you can analyze targets to the end, to the cows come home, but 3 to 5% is pretty good for the vast majority of stocks. Otherwise, an exit at 252 versus that's about a 3.5% profit on McDonald's. So pretty nice move there. Okay, it's just about understanding where those repeatable entry points are. You see, the pattern associated with that move there is not as compelling. Reasonable move, you understand, but that move up is not as compelling as that move up. The history associated with that pattern means that this is a lower probability trade. It might look pretty good and so on, but it's historically been every trade that looked like that had that momentum and that daily trend and that chart pattern is not as consistent as that one and not as consistent as that one. That's why there's no sniper, because we've analyzed each and every single one of these trading opportunities. Okay, let's have a look at some of the more recent trades. There's been some great moves of late, some really nice trades, big moves actually. There's a buying opportunity there. Some of our members got out for a 5% gain. Some of our members will actually still be in this trade. So long from, what is that, sort of 143 up to 173. That's about a 20% gain. That's how much this stock has already moved, a 20% move. And the reason some of our traders will still be in this is because this line hasn't yet turned red. Okay, so they're looking to maximize their profit potential. 20% profit. You did that with £1,000 worth, then you're up 200 quid on that. Okay, you had £1,000 on your account, you can do £5,000 worth and you'd have made £1,000. You actually a 20% gain is actually 100% return on investment. Okay, because it's 5 to 1, so you only need 200 quid on your account to trade £1,000 worth. Well, 20% of £1,000 is £200. So you've doubled. That's 100% return on capital. Okay, pretty decent. Do they all move like that? No, not really. The sort of the typical, the bite-sized move is that sort of 5% or so. Like I said, that's why I mentioned it before. Loss-making trade here. It's okay. It's fine. Look, you're going to have loss-making trades. That's okay. But a really nice winning trade there as well. Okay, really nice profit. That's American Express. So when you look at the Dow 30 stocks, you can look further afield to the S&P. I think we've got the S&P 500 in here. So whether you want to look at that many, it's kind of up to you. But you know, they're all in there. Like I said, this is a bolt-on to Trend Signal Plus. So typically, our members have already bought Trend Signal Plus, and they're looking to add stocks to their armory. So looking for something that can identify additional trading opportunities. Disney here. I should have bought that. I'm off to Florida later this year. That would have hedged my my cost of going there, because God, it's expensive, isn't it? But anyway, that's a 25% move. So that's long from $95 up to $125. Crazy. It's like a 25, nearly 30% move on Disney over 2 or 3 weeks. You know, pretty attractive. Goldman Sachs, lovely buy. Again, loss-making trade. Let's have a look at the difference in these, though. You know, this is a move that's gone, you know, best part of 15%. That's a buy. There's my stop. What was the difference in those? Well, we went from an entry at 296.5 down to a stop at 293. It's a 1% stop out. Okay. Had that have hit my 5% target, that would have been a 5-to-1 trade. Okay, it didn't. It was a loss, and that's okay too, right? That's fine. But a really nice buying opportunity from there otherwise. Okay. Again, what this system does is it helps you to identify the best opportunities on the biggest stocks that are out there at any given point. Okay. It's all about helping to identify a high probability entry point. That's what Trend Signal delivers. A high probability entry point. And then we teach you how to manage that opportunity based on how far these markets will typically move. Now, sometimes, you know, we get a bit less out of it than we might like, and that's okay. But sometimes we get pretty much it bang on. And, you know, you're not going to get every cent out of every move. You're not going to get every pip out of every Forex pair you trade. But that doesn't really matter. You shouldn't really be thinking about that anyway. But what you do get is a very clear trading opportunity for a market and a trade that has historically produced a fantastic output. And by analyzing so many trades and also incorporating the same methodologies that we do with Forex and commodities and so on, all adapted to stocks, it gives us an extremely robust strategy to add to our trading armory, really. There's our stop loss. Again, what is that? That's probably about a 3% stop, but a really nice move onto profit there for Salesforce CRM. Okay, Honeywell, we've got a mix of different stocks here. Again, look, I'm not going to pretend there aren't loss-making trades. That was a hideous buying opportunity. Could have shorted that, by the way. Would have been a nice sneaky little short for a quick couple of percent. But anyway, there was a buy. Okay, let's say you just did a 5% target on that one. That's pretty great. The stop would have been about 1%. So out of those two trades, you're -1 and you're +5, you're up 4%. I think we'd all take that after 2 trades, wouldn't we? 50% success rate, and we're up 4%. Pretty good. 3M, similar kind of a deal. Look, you know, it happens. There will be loss-making trades. But overall, again, on that one, we've got some really nice profits. So that's a 5% winner. Look at the stock. It's gone great guns from 132 up to 151. Worst case scenario, let's say you made 5% on it from the entry there at 130 down to a stop at 128. That's less than 1%. Let's call that 0.7% you've lost on that trade. 0.7% versus the 5% gain. You're at 4.3 over those 2 trades. Again, that's pretty attractive. Okay. That's probably pretty much. I mean, I can go through loads of trades. You know, Travelers here, similar kind of setup. Look at that, beautiful. And what's interesting is that there's no buy there, and that's a good job because that was would have been a loss-making trade. The pattern associated with this is not the same as the pattern associated with this. Okay, what's different about it? Well, that's something I'll have to teach you on the program, of course, but it's not the same, and therefore it has not produced a buying opportunity. This one did, gave us a sniper. It's almost going exponential now, isn't it? It's crazy. What's that up? That's up 10% or so. Okay, really nice opportunity there. And again, clearly identifiable with that repeatable entry point. Okay. Good. All right. So, guys, that's going to be pretty much it for me. I'm going to call it an end to the session there. Look, every week on a Tuesday, we go through different topics. You can follow us on YouTube, Facebook, LinkedIn. I even do it on publish these on my own Twitter profile, so you can have a look and and so on. You can come to GoToWebinar, which is better for the interaction and better for the chat as well, and you obviously get the reminders for those as well. But do continue to attend, and if you're interested in what we do here and you'd like to find out more about momentum stock strategy, you want to find out more about Trend Signal Plus, or even day trading with Dynamic Trader, then do please get in touch. We've got our phone number and we've got our email address here as well. I'm not going to give you a pitch or anything now. At the end of the day, if you're sitting there and you're looking for strategy that can help you to identify trading opportunities, that could help you to identify trades with a high probability or high strike rate, then we can absolutely help you with that. Not just in terms of the tools to identify the opportunity in the first place, but also how to manage that trade as well using a tried and tested formula. So we'd love to help you with that. So get in touch if that's something we can help with. Otherwise, follow us on Facebook, follow us on Twitter, LinkedIn, Instagram, whatever, and we'd love to help you. All right, guys, all the best. Thanks very much for attending. Hopefully, I'll get the opportunity to see you in a member workshop soon. Bye for now.